Backtests are often used as the go-to method for building systematic models. However, as we saw it, a backtest should merely be considered as the illustrative output of algorithmic design, and certainly not as a construction tool by itself. So today, as we have now laid a strict and highly discriminating framework in designing our trading systems by way of using the quantitative quadrant, it is time for us to explore what should be expected downstream of our technical work and go through a checklist of what typical perks and fingerprints a sound trading system should leave in its path once applied to real market data. Let's go through it. Besides real-time trading, there is arguably few other reliable and straightforward options to prove the validity of mathematical design outside of a performance backtest. Conducting said backtest after designing your system, as opposed to using it to build it, is key to prevent curve fitting from becoming a core feature and having statistical artifacts built into such a level that they will expose your system to instantly decay once thrown in the real world. The corollary does not mean that a backtest is useless though, far from it. In fact, whereas it should not be used to establish causation at any stage of your design, it certainly can be used to illustrate, reassert, and ultimately validate your mathematical assumptions. And it so happens that observing and scrutinizing the behavior of the statistical output generated by your backtest will invariably reveal a treasure trove of specific clues about the quality of your algorithmic work. For that reason, we're going to go over a checklist of 8 key characteristics that a successful system should let permeate through its backtest. Remember, just as with our quantitative quadrant criteria, every single one of these 8 characteristics should be checked, not just a few of them. Starting with Captain Obvious, and we will not waste time on this one, relative performance. The immediate advantage of a valid trading system should evidently be to outperform the underlying asset that it is applied to. If not, what's the point, right? If you wish to trade US equities, for example, your system should be able to beat a typical index such as the S&P 500 or the Nasdaq 100, or a given sector such as mining or biotech or what have you. You will have to determine that benchmark depending on the subset of investment universe that your algo is trading. Now before we move on, one thing here. Given the amount of public confusion, and who could blame you since most academic and financial press is always portraying it that way, quote-unquote beating the market does not mean generating a higher return than your benchmark. This misunderstanding is so deeply rooted among investors that I had to make a whole video about it in series 1, and I'll pin it again here just for you, top right. No, beating the market means generating higher risk-adjusted return. In other words, your system should generate more return per unit of risk used by the index, or generate less risk per unit of return offered by the index. However you want to put it, you need to compare apples to apples. Only normalizing for risk will yield a reliable verdict. Once again, comparing returns alone is irrelevant to comparing performance. Moving on. Your backtest should then portray solid absolute performance. Once again, normalizing comes in the picture here. Now, there are various risk-adjusted ratios, and it is hard to argue a hard and fast answer about which one is uniformly the best. That is why I like to use a flurry of them, all the while keeping in mind that each one is flawed in its own way. My go-to ratio is the MAR ratio, which compares the annual return to the maximum drawdown. In plain English, this ratio tells you how many units of annual return your system generates per unit of maximum cumulated risk. What I like to see here is a value of 1 to 1.5. Anything below is likely too weak, anything above has proved to be unsustainable in the long run. Also, one of the most common ratios to use is the Sharpe ratio, which normalizes excess return with standard deviation. This is a very standard ratio that can be naive because it does not discriminate for the volatility of those negative returns only, which is what we really care about discounting, and which is what the Sortino ratio does. Right there, I like to see a ratio of between 125 and 175 for sustainable performance. One last measure that I like to take into account is a profit factor, which is more often applied to single instrument trading and prop trading as a whole. The profit factor tells you the ratio between gross profits and gross losses. The reason I like to keep tab of it is because it indicates a sort of gain to pain ratio. A sound trading system should display values of between 1.5 and 225 over a wide backtest. Once you have determined that your system meets these respective thresholds, it is a good idea to synthesize these ratios into a single metric in order to limit scattering your analysis. To compute that synthetic score, what you need to do is take the upper values of these brackets, check what your system scores as a percentage of each one, and divide it by the number of ratios that you use. Let's take a numerical example with a backtest of the April 2020 version of Portfolio Trader Pro. Here we get a MAR of 1.41, a Sharpe of 137, and a profit factor of 2.34. based on the top end of the preferred brackets being 150, 175, and 225, I would assign scores of 94%, 78%, and only 100% maximum for the profit factor because I want to penalize those systems that show metrics that are too optimistic. My synthetic score would be 90.6%. Typically, I would want to see a score above 85%, and I will go back to the drawing board if that score falls below 60%. Next in line, a viable trading system should show smoothness in the distribution of its returns. Smoothness should not be underestimated because it fosters confidence and execution discipline, and a properly designed system should feature that quality without requiring any brute force optimization. An even distribution of returns is also extremely important if you happen to trade for a living, which I will come back to in a second. In plain terms, you would want your system to hit new equity highs as often as possible, regardless of market conditions. And there are a few ways to measure that. First off, the average drawdown days is a good starter indicator of how often your system will come back to hit that new high. A maximum value of 30 is preferable in order to expect hitting a new high every month. But out of experience, I can tell you that you would ideally want to see a lower value of less than 15 or 10. My personal equity trading portfolio, for example, hits as low a number as 8.62. Why so low? Because remember, this is merely an average which by definition hides the existence of outliers, hence the next metric, maximum drawdown days. A solid trading system should not keep you stuck in a trading winter for years on end, not even once. That is why it is important to stress test the duration of its drawdown. Most crucially, for those of you who trade for a living and will usually pay yourselves once a year, you will clearly want your system to generate profit in any given streak of 365 days. A successful trading system should take care of that. To be on the safe side, the system should display a value of half a year or 180 days to full recovery at most. A good way is to glance at your annual returns year by year. You would typically not want to see calendar year returns anything less than a quarter of your average compounded annual growth rate on any given year, with the exception maybe of extreme market cataclysms such as in 1987 or 2008. Lastly, a sound trading system should spit out a high value for R squared, high being defined as close to 99% as possible. R squared is a bit more complex of a statistic. It is literally the percent of variance explained by the model. Now, a more intuitive metric is to use the adjusted R squared, which describes the standard error of the regression. All you need to remember is that this value indicates how well the trading system wraps its results around an expected, hyper-smooth ideal outcome. Plainly, the higher the R squared, the straighter the equity curve. For the nerds out there, I'm including a table of correspondence between R squared and adjusted R squared. Another feature that your system should display is a very wide and stable parametric output density. This is a direct consequence of your system being built mathematically first, as opposed to using statistics and optimization at the design stage. Because your system is mathematically relevant, both small and significant variations in parametric values should only have very little impact on overall net profitability. Of course, that is not to say that there will not be sets of values that will severely undermine performance, but these should be confined to the obvious exception. The vast majority of combinations should yield stable results, with only those absurdly extreme values generating seriously degraded performance. Here is a prime example of what parametric stability looks like. As you can see on that 3D chart, the output is extremely stable across the board, with few peaks and valleys depending on the combined set of parametric values. This is symptomatic of a robust system built from math. The last thing that you would want to see is a scattered plot with spikes and pits of profitability with no rhyme and reason to themselves. This, however, is what you should expect from the real world to reflect back to you if your math was correct. On a side note, when people ask me why I allow myself to put my systems up for subscription, this is the precise reason why. The systems that I trade and that my subs trade are asynchronous with one another because we trade varying parametric versions of the same systems. And because this system's performance is impervious to parametric dependence, it allows me to create infinite variations that barely overlap each other and do not hog similar clusters of liquidity. The fifth fingerprint is a biggie because it flies in the face of yet another widespread algo trading dogma. Very often, you will read that if you trade equities within an index, for example, you should be very careful about including those historical components that may no longer be part of the index, but that your system would have traded historically. In other words, by making sure to include all components to have ever existed within your investment universe, you would want to remove what is called survivorship bias. The logical premise sounds intuitively correct at first glance. After all, you would want your universe of instruments to reflect reality as close as possible, right? Well, yes, if you believe in optimization as the basis for system design, that is. In truth, To get back to our sailing analogy, it makes as much sense as claiming that to test whether a ship can float, you would need to test it in waters from the 1600s. Fact is water, and buoyancy is buoyancy, which leads me to what a genuinely robust trading system should show. Its profitability should be 100% agnostic to survivorship bias, meaning that it should work just as well with or without including those historical components. Not only that, but it should remain just as robust by randomly including components foreign to that universe for as long as they pertain to the same asset class. Let me show you a real-life test to illustrate my point. One that cannot get much more real than that because I have traded it for years with my own fund. So if I were wrong and my assumptions were overly optimistic, I should have gone broke a long time ago. I'm going to use the backtest of the most extensive equity trading system that I have ever designed. What we are looking at here is over 103,000 trades since 1987. A lot of companies have come, gone ballistic, gone bankrupt, merged, etc. Here are the stats including historical components. And now without. Does it look to you like survivorship bias is of any importance? Not if math was used first, and even less so when observing it from a massively significant statistical sample. Number 6 on our telltale feature list is the breadth of your universe reliance. Let me translate my convoluted wording. It means that in order to generate its performance, your system should not rely on any particular instrument within your pickable investment universe. Imagine that you intend to build a system on commodities that's picking from a basket of 10 different futures contracts. You believe that you got your equation straight. You convert it to technical rules, but then your backtest shows that 3/4 of the performance was generated by trading on wheat alone. Clearly, there is something wrong here. If your design is correct, what you would clearly want to see instead is your system to be reliant on no particular instrument within your universe. It does not mean, though, that an instrument cannot produce outsized returns occasionally. For example, making insane money from GME alone in the beginning of 2021 for 2 or 3 weeks is not a red flag by itself. What would be is to have your system obsess over that ticker for years on end. I think you get my point. Number 7 characteristic that you will want to see is for your system's edge to be sufficiently high so that your performance is mostly inelastic to friction costs. Friction costs come in many shapes and forms, such as commissions, spread, slippage, missed fills on limit orders, rollover costs for derivatives, and plain trading errors that will inevitably occur at some point. For example, if your system is depending on being traded at a particular broker for it to remain profitable because of those trading conditions that you've negotiated, then you should be very skeptical of it. Or if you plan to trade Forex during the Asian session only, and your assumptions are that of constantly low and steady spreads, then you should be doubting your future live results as well. Likewise, if you plan on trading penny stocks, which you shouldn't be doing by the way, and obviously your system's profitability is going to depend on getting illusory execution with no slippage, then that's another huge red flag. Same goes for depending on limit orders in illiquid instruments in general. Complete fills are anything but guaranteed even if the market hits your limit. Or if you plan to hold derivative contracts long term, which will make you incur rollover costs, then this also might have a very dire incidence on your system's profitability. All of these cumulated examples show you that there are limitations threatening the viability of your system from many unsuspected angles, no matter how much sense it makes from a mathematical standpoint. These limitations will be revealed whenever live execution is taking place, and there is likely no credible substitute to live testing with real money on the line, which is almost always going to be required unless you trade the spiders with $10,000, of course. This basic stress testing is what phase 1 of my system's development process is also used for. So always make sure that your backtest assumes and clearly shows the impact of the most adverse execution environment when modeling historical results. But if your system does pass that test with flying colors, then that's another major sign that you got yourself a winner. The last feature is probably the most intricate and yet the most obvious clue that you designed a properly functioning system. We learned earlier that performance should remain largely consistent among parametric values, but actually the requirement goes beyond that. On top of being stable, the elasticity of that performance should respond with coherence to variations in parametric values. Let me explain. Establishing a causal framework in the early stages of system design implies that the translation of that framework into technical rules should retain the same coherence. Each rule used to model that framework into a numerical outcome observable in the backtest is expected to play the role of a singular lever that should consistently yield the same consequence on performance. Here's an example. This is one of my equity trading systems focusing on the 200 most highly liquid stocks pertaining to the S&P 100 and the Nasdaq 100 indices. Because my system is grounded in math, I know the outcome to expect from dialing each rule in or out. In this case, I know that decreasing the value of parameter C will consistently give me more return at the expense of smoothness and vice versa. So there is a tight coherence between the changes of my parametric values and the expected outcome of my system's equity curve. We are not cluelessly slapping values in and randomly getting scattered results as in a blindly optimized system. Instead, we are intentionally dialing our parameters in and out, and we are getting the expected risk-return profile by design and by choice with non-elasticity each and every time. This is only possible with a coherently designed system. So here is a recap of our 8 features within our checklist. This course was maybe a lot to take in, but it should show you the unmistakable benefits of grounding your system in math right from the start. We're not doing it as a fashion statement. There are real-world, testable features with real money consequences, most notably when it comes to building lasting edges, or on a larger scale, when combining variations of systems within a decorrelated portfolio set. So now we've been given a general frame of reference to guide our research, and that we know what quality output to look for. It is time for us to proceed to more minute aspects and compartments of quantitative trading. This series 2 still has a lot more to give with that respect, so stay tuned, feel free to ask questions in the comments below if you need clarification, and make sure to subscribe to be alerted when the next class is in. I'll see you in the next episode, guys. Stay sharp.